Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of the XTB, and it's my pleasure to host you during our weekly trading webinar. So let's start, and today we are going to talk mostly about the global markets and discuss whether this stock market correction could be already over. But typically, let's start from what's hot on Monday morning. And as you can see, for the photo of the week, I picked oil prices, Brent oil prices that are continuously on the rise. As you can see already on the chart, they're above the level that we saw before the virus outbreak in the spring of 2020. I think this energy crisis, despite some reversal in natural gas prices in Europe and the US as well, is still very much the story for the markets, as coal prices in China hit all-time highs today as floods crippled output just when it's needed the most. Evergrande is likely to miss its third coupon payment today. So you would think that these stories that roiled markets over the past few weeks are still very relevant. However, markets move on and indices rebounded strongly towards the end of last week. So the question is, are these stories still the scare out there, or should we buy the dip and just forget them? This week is mostly about the FOMC after the weak NFP report last Friday. The question is, are they going to taper or not? So this is something that we're going to discuss as well, and we'll do it now. So the question is, first of all, how bad was this NFP on Friday? Well, on the surface, it didn't look great, right? I mean, we had less than 200K in September after a similar disappointment in August. So you could argue, okay, the labor market is losing steam as we had really minor increases in employment for 2 months. But the point is that this is not as bad as it looks for many reasons. First reason is that if you strip out government, you already have employment above 300K, because this debt ceiling story in the US, because we discussed that on a few occasions already, and the thing is that the government, they had to get rid of some temporary employment in order to save money, because they didn't know for how long this political farce in Washington will be continued. So this is part of the reason why this NFP was weak on the surface. Secondly, and it's a bigger story, if you look at unemployment rate, it actually tumbled from 5.2 in August to 4.8 in September. So this is really very significant decline in unemployment, because you could argue, how is this possible that employment increased way below the consensus and then unemployment rate decreased so much? So it doesn't make sense on the surface. But the point is that these are two very separate surveys. So the employment is survey of companies, whereas unemployment is survey of households. And if you look what the companies are saying, they say, look, we want to hire, but we are struggling to find appropriate candidates. And this is reflected in a weak employment and in accelerating wages, because quite simply companies need to pay up in order to fill at least some of the vacancies. On the other hand, households that were in a great position this year, because they got a lot of transfers, they are in no rush to get back into the labor market. So they say, no, we are okay, we are not unemployed, we just don't want to come back. And this is the big problem, and this is something that I think at least the Fed will consider, because they focus a lot on the unemployment rate. Also, there were other technical factors like hurricanes in the US in September that could hit employment temporarily. And one small thing that you could observe in the data is that automotive sector is already laying people down. It doesn't make a big impact on the overall data, because it's just 6K. The sector doesn't have that much of a contribution anymore, but it's showing us that it's a supply side that has a problem. It's not the demand side of the market. So to wrap it up, I don't think it's going to really discourage the Fed from moving on. So unless we get other factors like a big market correction or I don't know, big positive surprise from inflation, which is unlikely, but still, then I think they are very well on track to taper. And if you look, actually, if you look on the bonds market, with the bond yields surging as they are right now, I think this just confirms that the market expects the Fed to follow on their suggestions of starting some reductions in their QE in November. This will also obviously have some impact on the dollar. As you can see, we have some slight profit taking on the euro dollar here, but frankly speaking, it doesn't look very promising for the euro, because this profit taking is taking from below this support. So we had very weak attempt to defend this 116 area, and then it was broken in the middle of last week, and right now there is just some relief buying, I would say so, but the trend remains very strong. And with bond yields moving in the direction they are moving, then well, it doesn't bode very well for the euro dollar over here. Right, so let's move on to the story of the week, and the question is the market correction done? Well, if you look at the global indices, first of all, they didn't see any meaningful correction from the beginning of this mad rally from March 2020. However, there were some minor profit taking, like you can see on the Nasdaq here, and we just had another one very similar. So from that point on, many investors will be tempted to buy the dip, because they will tell themselves, look, this is as much as we can get on this market. We're not going to get anything more than this. Traditionally, on the S&P 500, what you got, what was at least 8 to 10%, that was a small correction, and then there were larger, obviously, corrections between 15 and 20%. So you could say, okay, we are not there yet. However, as I said, looking here, there wasn't any at least 8% correction since the beginning of this massive rally, right? So let's argue why actually markets should be scared. What were the reasons behind this weakness that we saw here? So first of all, I mean, I don't know, first of all, there was this Evergrande story in China, which is still there. As I said, the developer is very likely to miss the third coupon payment today. However, because there were no very, very strong and direct ramifications, the market has a tendency to just forget it. Like, okay, it's happened, it's negative, but it has no global, massive shock waves, so we forget it. A second thing is this energy crisis. As I said, we are very much there. However, after this reversal in natural gas prices, again, there is I feel there is a sentiment on the market that maybe we are past the peak of this crisis again. And then there is a tapering in the US, which is which we just confirmed. It's very much the story that will be there. But again, the markets just got used to this idea, and I think the bottom line is that these factors are no longer the scare. I mean, they are negative, but with this massive tendency to buy the dip, I think there is just not enough of fear on the markets to really trigger something big. But let's go quickly through them. So I think from those three, the biggest tail risk for a global economy is the energy crisis, because we are in a situation where the economy is already slowing down a bit from the peak that we had earlier this year, and there was a hope that inflation will cool down and will allow for the monetary policy, for policies in general, to be very accommodative and to support this growth for years to come. However, if inflation is elevated, then obviously there is a risk that this may not be the case, and very steep energy inflation is the last thing the economy needs right now, and it's very likely that it will get it. So yes, there is a lot of focus on Europe when it comes to this energy crisis. However, the bigger story is in Asia. In India and China, there are very low inventories of coal. Because of these climate policies, some of the production was quite simply shut down over time, and right now when there is a lot of demand, there is just not enough of the supplies. So if you look here on the inventories of coal in China, we are at multi-year lows right now, just ahead of the winter period. So the big story is that with China urging, the Xi Jinping saying, okay, we'll take care about the climate later, we need to get through this winter, so start pumping this coal again. But it might be too late, because as I mentioned at the beginning of our meeting, we had floods in the regions where a lot of coal is being mined in China, so it doesn't look very convincing right now. And we are in a situation where weather may have a very huge impact on the global economy. Usually weather is something that we discuss when it comes to some agricultural commodity markets like coffee, cocoa, corn, soybean. These are the markets that are where investors need to track weather a lot. However, for indices, for forex, major commodities, usually weather is of second nature at best. However, this time around, a freezing winter will be very negative for the global economy. It's the last thing that we need, and there is a risk that we'll have something that is called weak polar vortex or disrupted polar vortex. As the scientists, they say that it's likely this year, that will send very cold air from the north to the northern hemisphere, which is US, Europe, and China, at least some of these regions, which will basically increase demand for energy commodities. And obviously with this situation that we have, it's something that is a very, very significant risk. So we have this situation where on one hand we have buy the dip signals from this very aggressive market. If you look at this sentiment indicator, which I do from 6 other smaller, I would say, data like options, investor sentiment, deviations from averages. So if you look here, you see that we are at the first line of support, kind of, right? So we are here last year, we are here again, we are here somewhere in 2019. So these are profit-taking levels that were achieved, and the market continues moving on from them. And so this is very convincing for investors to think, okay, look, like I said, this is what we got, and there will be a greater correction because this is such market. Then again, investors are they need to consider the longer term fundamentals that are increasingly worse. And if you look at the PMIs, the global PMIs, it's still elevated. However, industrial PMIs for crucial industrial economies, they're already slowing quite significantly. So the bottom line is that, well, yes, technically it looks like buy the dip. It looks like all these situations, it's very clear, especially on the Nasdaq. You can see here that you had a couple of such corrections, or it's like I said, it's not even corrections, like larger profit taking, where you had a smaller dip here. Well, first bottom and the second bottom, first bottom, second bottom, first bottom, second bottom, and here again, first bottom, second bottom, and a strong revival from there. And technically, it looks like a repeat of what we had in the past, and it may very well be so. However, like I said, from with all these stories that are still very much there, and the Fed still very likely to deliver on the expected tapering, I think that the fundamentals have the worst prospects they had in many months. So this is something investors need to consider. Okay, we can play by the dip, but if it turns out to be worse, if it turns out to be the game changer, and we don't have any more fuel, they need to be ready to abandon the ship. This would be my bottom line here. All right, so let's move on to the markets this week. And as I said, and we have a lot of stuff from the US. After this NFP being less than convincing, the focus will be on inflation and FOMC protocol on Wednesday. These are the two major things that investors will be looking at, because obviously inflation, if it stays elevated as it is, obviously it's a thorn for the Fed, and the FOMC protocol, obviously the latest FOMC meeting was a bit unclear. They suggested tapering, but they didn't tell it explicitly. So investors will want to see, look, what are the conditions, what they were discussing. Is it a done deal, or is the door open for possibly, kicking this can down the road a little bit more? So yeah, I think the minutes will be very important. So Wednesday is certainly the day to watch for the US markets. Other than that, we have also other data, especially towards the end of the week. And I think these speeches between Tuesday and Friday, and we don't have Powell, but we have, for instance, we have Williams from the New York Fed, and they will, the markets will be interested if they comment the NFP, if they suggest that does it have any impact on the tapering decision or not. So this is something, again, worth considering. Okay, ladies and gents, thank you for your attention. It's been my pleasure to have you here, and we see each other next time around. In the meantime, please stay with the news section in Xstation mobile platforms, where we update you every day with all these major developments on the markets. Have a great week.